But I think it's pretty clear. But I'll just make the point too that when we spoke a year ago, one of the things that I pointed out was that the insider sell to buy ratio was off the charts. We saw a 13-week ratio over 50, which is higher than anything. This was March, April last year. And the 12-month ratio was as high as it's ever been. That is, for me, and the things that I track, one of the best leading indicators of economic activity, of earnings, and of stock prices that you'll want to see. So when corporate America in aggregate last year was heavily selling, that was insiders, essentially the C-suite of corporate America saying, the economy is going to disappoint next year, and in a material way. Earnings are going to disappoint, stock price is going to disappoint. I also pointed out that that was one of the 350s. The other two was the Mag 7 were trading more than 50 times free cash flow, which I just thought was an obscene valuation. By the end of the year, they were trading 60 times free cash flow in aggregate. And we had seen last year 50 Titanic syndromes triggered on the New York Stock Exchange and the NASDAQ, one of the biggest breadth warnings we've seen in stock market history. So high valuations, extreme breadth warnings, and insiders being very, very bearish was kind of the trifecta, the bearish trifecta, saying that the economy and the stock market next year are going to disappoint to the downside. I don't think we've seen the extent of it, but I will say I think the policies implemented so far this year only add to that bearish economic case that was already building for the last 12 months.